Hey everybody, this is Bob Trade Genius. Got my good friend Phil here. I don't know what Powell saw, but it scared him and it should scare you. 18-month bear market inbound. We'll tell you how and we'll show you why. Stay tuned.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening. Okay, Phil, math is on our side. We've been waiting and waiting and waiting. Powell finally said the R word and he said the C word, and that puts the clock on. What say you?
Yeah, we went from, don't expect a rate hike until 2025 from the previous meeting to this meeting, all of a sudden out of the blue. Oh, by the way, you're getting 3 cuts probably starting in March. It's like, what? Wait, hang on a second. Nick Timiraos, which if you guys aren't familiar with him, is essentially the Fed spokesman when they can't speak and then in their blackout windows, he's the leaker. Essentially, he's in their back pocket for all intents and purposes. But basically, this is what he tweets out. It would be premature to speculate on when policy might ease. This is December 1st. Something happened between the 1st and the 13th where we hear that rate cuts are something that begins to come into view and clearly a topic of discussion. Previous meeting, he said, there's no discussion of rate cuts. He literally said that. And he goes, at the earliest, we'd probably see it as 2025. So something happened between the 1st and the 13th that I think really scared them into, getting ahead of the rate cut discussion. I mean, just a very quick pivot. And, we were kind of speculating today, Bob, on what may or may not have transpired. I think it really comes down to the stability of the bond markets and the stability of the banking system. And I think there's some big issues there that I think Powell figured that it would be better for him to just do an about face and catch some heat on that. At least he could then say, well, hey, look, I was addressing the issue and they haven't been forthcoming on what this issue is, but there's an issue here.
Well, look, the collateral default swaps, if they kept raising rates, would make the banks uninsurable. That's another area to think about. Mm-hmm. Number 2 is that Janet Yellen won. She basically pushed all the weight of the boat to one side of the boat and just basically said, you can't fix it, so you're going to have to bail me out. And so she went all in. And now with all these T-bills on there, they have to lower the rates or they destroy the bond market. And the third thing that everybody's talking around because people don't really know how it'll affect it, but China is ready to implode, number 1. And number 2, the Japanese yen is ready to explode. So I don't know, pick your poison and it could be all 4 of these things, Phil, that are manifesting themselves, plus a slower economy. Mm-hmm. And so in my view is that he did all the huffing and puffing he could, and he got basically the inflation rate down, the official rate down to 3.1%. We can argue on that one all day long. And he's pivoting already. And what immediately happened? Bitcoin, gold, silver, oil, natural gas all ripped on these last 2 days. And I'm talking about these moves we had with SPY and we had with commodities. One of them was a 2009 event. Okay, 2009 event. And the other one with all the other metals, miners, and Bitcoin here is that, we haven't seen these moves in months. And we're putting swing lows in, at prices where I don't think he would prefer it. So, but we have some more data, Phil, if you want to throw it out here now, that says, hey, look, you and I just made a bold claim here, but we have math on our side. And our math is 100%. Okay, these moves, when they happen, are inescapable what they do to the market. So people can troll us all day long on higher for longer and bull markets here forever, yada, yada, yada. Math tells you a totally different story. And Powell can't walk back these cuts now.
No, he can't. And, whenever you have, here's a chart where it shows you the time frame between the last rate hike, which we got a couple months ago, and the first rate cut, which basically, for all intents and purposes, we're expecting now, and the market's expecting in March, and the Fed is all but guaranteeing that at this point. And so that gives you like a 6-month window between that time frame of the last rate hike and the first cut. And in this chart, it shows you kind of the different timeframes that we've had. We've had 7 months, 15 months, 8 months, 5 months. We're more and more, we used to talk about like, what does this current situation look more like? Is it the great financial crisis or the dot-com boom? And we've kind of had situations where it looks like the dot-com bust, and now we're starting to look like more and more like the great financial crisis. And we're going to show you guys why in a second. But the shorter duration between the last hike and the first cut tends to lead to more volatility. And if we're looking at a 6-month time period here, that's on the short end of the spectrum here. Some of them have been even shorter, like obviously on this chart, there's been 3 months and 2 months. High areas of volatility, because those are where they have to react quickly to something that's breaking. And I think that is really the core here. Now, if you are coming from the standpoint, see, the other thing we could argue here is that he knew he was going to pivot, and he knew he was going to hawk the whole way, and he was going to try. So if the banking system that you're saying, Bob, you're in charge of the banking system, you're going to make sure that the banks are okay. They're not healthy. They're in trouble. What do? You get them out at the top of the market and you lock them into 5% gains through a recession. And that's essentially what I think is happening here. He's basically ringing the bell. The market's at the top, and he's basically saying now, not basically, he is saying that we're getting a recession. And that's been something they've been kind of fighting this whole time, where it's like, nah, I don't know, we're going to get a recession. Oh, if we do, it's going to be mild. He flat out was asked at the presser yesterday, and this is something that was glossed over, I think, in the headlines, while everybody's rooting for the Fed finally threw in the towel and the markets are rejoicing. But he said we're likely going to have a recession next year. So I think for them to pivot as quickly as they did, it's not just a recession. I think it's going to be a long, drawn out recession. And we've always pounded the table that the bond market never lies. So that means that we have to look at, what happens around these rate cuts, what happens with the markets. So if you guys look, right, if you look at what I would consider our modern, central bank policy era, it's after the dot-com bust, after the great financial crisis. And notice how the market reacts. Whenever the yellow orange line is the Fed funds rate. And so we are plateauing again. Look what happens when we plateau every time, right? We plateau and we get a drop in the market eventually, right? Over toward the left, you had a plateau, and then you had the extreme volatility there in 2018, 2019, ahead of COVID, and then they panicked and stick saved the market. If they didn't come in and stick save the market, that drop that you had there, the Fed funds rate, this last drop to zero before this most recent rise over there on the right of the chart, that would have gone down much farther and longer, and they stepped in and panicked, and that gave us our current round of inflation. But here we are plateauing again, and the Fed is telling you that you're going to get another drop back down on this graph. And as you guys can see, that is, and Bob, you were saying that earlier, it's just not bullish for the markets when you get into a rate cut regime. And so, wow, here we are, the Fed was saying, forget about it till 2025. And now all of a sudden, I just think, Bob, it implies that they're trying to lock in the gains here for banks. They're trying to get them into the safe haven trade, and they're gonna get assets. He couldn't get the long end to work for him because of Yellen. So then, how else can you get inflation down? Well, you have a nice big fat recession, right? And that will get asset prices down, and that should tame inflation back down to 2%. And so that's where I could see him going. But if he's wrong about this and inflation reignites, he's going to go down in history as probably one of the worst. This is going to be one of the worst decisions they've ever made.
Yeah, I mean, look at it from this standpoint. So TLT is essentially unchanged for the year now, and it was down 18% at its lows, Phil. It is unchanged for the year. And so if you bought those lows, and we were telling people, remember how people thought we were idiots when we said buy TLT at $82, $84, and now it's at 99, okay? And it has a yield. So here's the thing, if you were a pension fund guy, in the last 6 weeks, you just made 15% on your money on TLT.
Right.
So why would you take risk in the stock market going into a recession when you have something that, if the 10-year goes from 4% to 3%, you're looking at, that's a 25% gain in TLT in their price appreciation.
Right.
Why would you want to be in the stock market? This is like go to sleep, head on vacation money. Right. And in the meantime, you're picking up a yield. So that's why it happens, guys, is that as rates cut, people in the bond market are making a fortune on the price appreciation of the bond. And so it makes bonds much more attractive than stocks. stocks, and at the same time as cash flows are drying up, liquidity is drying up in the stock markets, everybody just shifts over to the bond boat, and you get a sell-off in the stock market every single time.
Yeah.
And so I don't care. You can't argue with me on it. This is the no-brainer trade of the year coming up. And Powell would not have said it if he knew he was going to walk it back. And so they're now in a rate cut regime here. And, they say March is interesting because it's probably going to be the bottom of this first sell-off after these year-end flows end up, Phil. So, and look, and we still don't know. That move to 4,700 yesterday on SPX. We don't know how much of that front ran some of Santa coming out here with the January effect. So it's going to be really interesting to see, how this market plays out over the next couple of weeks. But after January 12th, that's D-Day. And I highly doubt there's going to be a whole lot of structural inflows into calls for the February and March contracts.
Yep. And, so then that's where the rubber meets the road. So I think that's helpful to look at like the relationship here with the yield curve now again, right? So we've talked about the yield curve. We've warned about the yield curve. And now with this clarity, we can look and see like this is where we bottomed out, right? And we told you guys that historically, when you finally put in the bottom in the yield curve, it's typically somewhere between 100 and 120 weeks. And that takes us all the way out to October 25th. Now, what's interesting about all this, and we've said this repeatedly on the channel, is that, that it's invariably going to be a long recession if this continues to play out. So what's been playing out is that it's been more along the lines of the great financial crisis fractal. And because we've gone and pushed up to higher highs, even though we've had a yield curve inversion that's bottomed out and gone up, sometimes that pinpoints the highs in the market. But this is starting to look more and more and behave more and more like the great financial crisis. And you can see we're following along that same fractal here. And basically you're coming to the point where you top out, you're going to have a pullback. We've talked about a pullback in March due to flows and other reasons. And that's exactly where this fractal dips. Then you're going to get an echo rally back up, okay, and test the highs, and everyone's going to think coast is clear. And we roll over. What confirms that this is going to be playing out like this is this yield curve inverts and actually goes back to zero. Now, I've said repeatedly, and Bob's backed me on this, is that, whether or not we're in a recession, you can argue that all day long, but it's clear as day when this goes back to zero and starts cracking back into a normalization curve that you're going to be in a recessionary environment. Now, at that point, it's very key to watch the relationship between, say, TLT. Really, it's the bond market, but TLT is probably the most popular measure, TLT and SPX. Because then what's going to end up happening is you're going to have the continued, the $90 to $88 that we've been pounding on that level. And we basically, what they did was, we saw the institutional flows at $88 on TLT. A lot of times when institutions are positioned, there's always a head fake move lower or a head fake move higher, depending on their positioning. And you think, oh, it's toast. And then it gets that reclaim. When we saw 88 reclaim, you already knew, you knew that bottom was likely in, and then you're going to start getting this expansion back up. So you're still in arm's reach of that area, but it's going to become very clear that that's where the bottom was as this continues to play out. And so when TLT rises and equities diverge lower, guys, that's a classic recession trade. And so really that's what you're watching for now. And I think that's what the positioning is here now. They're slowly getting out at the top, and they've been getting long the bond market. And it helps out the banks a whole bunch, like I was saying earlier, because now they're out at the top. They can cash out. They can lock in these 5% gains. They can help dollar cost average some of their toxic bond positions that they had from the low interest rate environments, right? Where the TLT was up over $100, like pushing 120, 130, whatever it was. They're stuck up there, but now they can dollar cost average down to 100, 110. You're easily going to get back to that in this regime. And then that takes us to this fractal playing out, and we finally puke out. And if this 210 prophecy is correct, then we're basically looking at a bottom of a bear market in October of 2025. Nobody anywhere on the internet right now is telling you that a bear market is going to bottom out in October 2025, or that Bitcoin is not going to have its post-halving rally until after that. But beware, the bond market is telling you that you should fully be of the mindset that can play out. And I think that you have to be aware that this is where things are headed. And don't be surprised that 2024 is a long, drawn-out L-shaped type of move. And then we finally get, I'm very bullish beyond 2025, don't get me wrong, but this can get very dicey next year.
Yeah, and just a couple of asides. We also had natural gas has been destroyed in the last 6 weeks, and it's now had put in a swing low, 2 strong days. It went into backwardation fill, which usually means, and the contract ends on the 26th. So this could be an environment where natural gas explodes higher. When you start seeing these future and what backwardation means is that the contract that's expiring next is higher than the contract that's 1 month out from it. And it kind of goofy foots the speculators a little bit, and they got to start covering their short position. And they literally have 1 week to go because the 26th is a Tuesday and the 25th is the day off and the 26th is Boxer Day. So a lot of the European traders are going to probably want to be out of their trades by the middle of next week. And so, you're going to start seeing backwardation in gold and silver and oil and natural gas, and these commodities are going to get these spikes, and it's going to be blowing up shorts. The other thing I learned is that I'm going to test this out, a little back data, is that natural gas and the VIX kind of work together. Now, I intuitively knew that in a bit because I always laugh. I said, whenever the market sells off, natural gas goes higher. So it must be used as a funding source in that contango environment to use it to speculate in the stock market. And so when VIX goes higher, natural gas seems to go higher too. So keep an eye on that. It's a really interesting piece of information that I haven't fully validated, but I do know that when the markets go down, natural gas tends to rise because they probably it's a speculative asset to short it, and they have to cover their bets. The same thing's going to happen if the yen starts turning higher too. I mean, we could be in for a lot of confluences of events here that could blow the shorts and commodities sky high and blow the longs out. You get liquidation longs here in the indexes, and it's going to be it could be a pretty wild next 90 trading days.
Yeah, and here's a non-back adjusted chart of the natty gas futures, and you can this rectangular areas. I mean, that's where your home runs come from. So you could certainly see, there's still room to get down in there, but like Bob's saying, look, I think the values that we saw for natural gas hitting like $9, and obviously it's been higher in the past, right? But you're setting up for a ripe trade. And I think ultimately asset prices are going to go higher. Inflation's not going to be at 2%. The cat's out of the bag on this stuff. If we get a recession and they claim they get their, they can do their victory lap around 2% inflation goals, that's great. The fact of the matter is we're dealing with 20% plus inflation from 2020, and we're not going back to those prices unless we have a deflationary collapse, guys. You have to just kind of move on from that. They're going to do a victory lap at 2%, and then at some point, the next bull cycle, all these asset prices are going to inflate, and that's why you really can't be sitting in cash once this next cycle pulls back. You gotta be in assets that appreciate going forward. But I fully expect going into the next cycle beyond 2025, we smoke these natural gas prices, and it's just going to be a new normal. So yep. These are generational lows that we're about to make here.
Yeah, look, risk rewards in your favor here. I put a back ratio trade on KOLD for the end of next week, and I took my short leg off yesterday, and we're down $15 from that move, and it could drop another 50. So there's a lot of room left in that trade, and check it out, and check what we do out. We did 3 boil trades today, day trades. We don't normally day trade, but it was just so sweet. So we find different ways to help people make money in the markets on the long side for those who think we're bearish, and we're fully prepared for the bear that's coming though. So thanks for listening. Hit like, subscribe, hit the notification button. Let us know what else you want to talk about. We'd love to hear your ideas. Tell us what you think about what we talked about here for recession, bond market, rates, etc. And really appreciate your support. Have a great day.
See you.
Trade Genius.